and I believe gold's going much, much higher. I mean, I believe both gold and Bitcoin. My projection for next year, kind of calendar 2025 year end, gold will probably be at $4,000 and Bitcoin will probably be at 150 or $200,000.
Lawrence Lepard begins by emphasizing the immense potential for gold and Bitcoin to serve as the bedrock of a restructured financial system. He predicts that by the end of 2025, gold could soar to $4,000 per ounce, while Bitcoin may reach a staggering $150,000 to $200,000. His projections are not mere speculation. They are rooted in the underlying monetary and economic pressures that are reshaping the global financial landscape. Lepard foresees a deflationary shock followed by unprecedented monetary intervention. The Federal Reserve, he predicts, will engage in what he calls the big print, expanding its balance sheet from $7 trillion to $20 to $30 trillion. This massive liquidity injection will aim to stabilize the economy, but will also unleash significant inflationary pressures. Such an environment, Lepard argues, will drive gold to $10,000 per ounce and Bitcoin to $1,000.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
They'll both be up substantially from where we are today, and gold stocks will take off. The real cheap asset right now are gold stocks. I mean, as I'm sure you're aware, and you sit in Vancouver, I mean, they just haven't gotten that much love. I mean, gold was up 20 or 30% this year. The stocks are up a similar amount. Typically, the stocks, multiply the return on the metal by 2 to 3x. So gold up 10%, stocks up 20 to 30. That hasn't happened. The reason that hasn't happened is that people still don't believe the $2,600 gold price is sustainable. They think Bloomberg consensus estimates are that it's coming back down to 2050. My view is it's going to 4,000. So, one of us is going to be right. If I'm right, the gold stocks are going to go a lot higher in the next year, which is obviously what I'm betting on. And a lot of people think Bitcoin is just a liquidity widget and it trades with the NASDAQ. And there's certainly been a piece of that. But I think over time, I mean, it's interesting today that the stock market and the NASDAQ are up and gold and Bitcoin are down.
Yeah.
I think over time, Bitcoin is going to trade much more like gold. It's just going to be more as a sound money asset rather than as a liquidity widget like the NASDAQ. And I foresee a time when the stock market bubble bursts. I think what will happen is the stock market bubble will burst. That'll be very, very deflationary, very bad for a lot of markets. And, the government will have to come in with what I call the big print. And when the big print comes, then you look out. Then Bitcoin's going, and by big print, I'm talking about the Fed balance sheet goes from 7 trillion to 20. And, Powell says whatever it takes. And this is all because, CRE or something else is blown up and they can't contain it. And, I think the Fed balance sheet will go to 20 trillion, 30 trillion. And as you know, that'll be enormously inflationary. But it'll also send gold to, 10,000 and Bitcoin to 1 million. And so earlier this year, when gold broke out in March, gold went through 2070 and Bitcoin was just sitting there. And I had all my Bitcoin friends saying, hey, what the hell's going on? You guys are crushing us. And I said, no, you're very happy this is happening because Bitcoin usually moves with a lag. Gold is really, really good at smelling and sniffing out monetary debasement. And the reason gold is backing off right now is it thinks that maybe Besant's going to solve it, and they're not going to have to do the monetary debasement. And what I'm here to tell you is that my belief, strong belief, looked at the math, looking at it carefully, is that they can't solve it. They can maybe take the edge off it, make things a little bit better, and that's probably a good thing for the world because we don't want a messy, economy. We don't want anything to crater and have another great financial crisis. But they can't really solve it, and so ultimately, we're going to have higher inflation, and then we're going to, as that continues, there's going to be a lot of political outcry. The Fed, I think the Fed is really losing its grip on things. I think the Fed's under a lot of fire. There's a book out that I would highly recommend to people, and you as well, David, called The Lords of Easy Finance or The Lords of Easy Money by Chris Leonard. So here's a guy who is a Wall Street Journal reporter, very mainstream, nothing controversial about this guy. And he wrote this book that is actually a devastating criticism of the Fed and how out of control it is and how it creates these cycles and how they blew the call on so much of this stuff. And so he wrote it and he said all those things. He said them very polite way. My book says the same stuff, but not so politely. Um, and but here's the thing: he got positive reviews from the New York Times, the Financial Times, the Wall Street Journal. They were all like, "What an amazing analysis!" And so, I think the Fed is in a lot of trouble, and I think that there is going to have to we are. The problem we are encountering, we have serious monetary issues going on in this world right now. And that's going to, I think, become increasingly apparent. And we're going to have to address them. You got a problem. The first thing to do is admit you got a problem. The next thing to do is figure out a plan for how to address the problem. And these aren't fatal. It's not going to ruin the world. But, there'll be winners and losers. And, to get the problem addressed and to have a better world, I'm in this because I want my kids who are in their 20s to live in a better world. To get there, we got to go back to a sound money standard. They're both forms of sound money that we can use to mark our balance sheet up against. If you're going to devalue the dollar, we've made too many dollar commitments. We've got too much dollar debt. That's the fundamental problem, correct? Good. So what do we have to do? We have to devalue those commitments in terms of something else. And the something else is a form of sound money. And the two natural choices, there are really only two in my view, are gold and Bitcoin. Gold is analog sound money. Bitcoin is digital sound money. So as a result of that, if you're going to devalue the dollar, and this is what Roosevelt did. Roosevelt grabbed the gold and then he immediately changed the price from $20.65 to $35. It was like a 70% devaluation overnight. And what it did, and by the way, it helped right after he did it. 34 was a pretty good year. And so, if you're going to devalue, if you've got too much debt, it's like doing a restructuring. It's like if you owned you owe 100,000 on your credit cards, and the credit card companies know that you can't repay it. They just know that you're bankrupt. You can't repay it. So what they would say to you is, okay, I tell you what, we're going to cut a deal with you. We're going to write that 70,000. Now it's going to be 25,000, but you got to repay it. You got to repay it in sound currency. It's the same kind of idea. We're going to devalue the debt in terms of something else, and the something else is going to be the new form of money, and the new form of money is going to be sound so that we can't print it. And so, this alcoholic that used to have alcohol all over the place and could always go grab another bottle and get drunk, well, we're going to take away all the bottles, So, because the new, you can't print gold, you can't print Bitcoin.
Lepard also discusses the mechanics of a potential monetary reset. By significantly increasing the price of gold, potentially to $20,000 per ounce, the U.S. could use its gold reserves to pay down national debt. While this would trigger one-time inflation, it could pave the way for a more stable economic framework. He acknowledges that there is no painless way out of the current predicament, but insists that a return to sound money is the only sustainable solution.
Obviously, they're correlated to this because they both took off in 2020. Just as this went up 42% during COVID, right? And they both took off like a rocket. Mm-hmm. So they're very heavily correlated to this. But keep in mind that this is indirectly correlated to the thing you referenced, which is the debt to GDP, that the government runs. And so, because, effectively the Fed is the monetary mechanism that creates the growth in the M2 by putting the reserves on the bank balance sheet. And if the price is low enough for that cost of credit, then the banks loan it out and M2 grows. So they're all birds of the same feather. Do you know what I mean?
Yes.
So I watch them all. I watch the Fed balance sheet. I watch the interest rate. I watch, M2. I watch global liquidity, and I watch the stock market. Again, I go back to the stock market. That's the one that everybody's missing. Unless we think about it now, we haven't really had. We had some very sharp bear markets, but we haven't had a truly prolonged and serious bear market since '08. Since '08, it always paid to buy the dip. No matter where the dip was, it paid to buy it. You came out and you got made whole, and it went higher. And having studied financial markets and looked at history of hundreds of years, and having been in them since the '70s, I just know that that's not a condition that will always be true. And so I think there's a real day of reckoning coming with the stock market, which is a bad thing. And I think that will reflect on the economy, spending, and everything. And I think the Fed will respond by saying, okay, fine, we're going to do what we've always done. I mean, their hammer is the printer. And so every financial problem looks like a nail. And so they're going to turn on the printer. And, we know what that means. The last time they turned on the printer, my fund went up, 98% in 1 year and 122 the next. Bitcoin went from 10,000 to 50, and gold went from 1365 to 2070.
But you wouldn't be positioned to the equities markets in that scenario as well?
No, I wouldn't. I really wouldn't, because they're not cheap to begin with. I mean, don't get me wrong. If we have a hyperinflation-like scenario, as anyone who's studied history knows, stock markets do well with really runaway inflation. I mean, the Venezuela market, the Weimar market, the Zimbabwe, I mean, everything goes up, because at least a stock represents a claim on a business that will reprice in the new currency. It would mark the debt down in real terms. You would say, I mean, as Luke's example would be, we have 261 million ounces of gold, or they believe we do, and we might. You would say suddenly the U.S. is going to buy and sell gold at $20,000 an ounce. For every $4,000 you mark it up, or every $1,000 you mark it up, $4,000, you get $1 trillion into the TGA, and you use that to pay down the debt, and we get the debt to a manageable level again. Now, if you mark gold up that much, that would be a very inflationary event in worldwide terms, and so the U.S. would suffer pretty severe one-time inflation. And I think the bottom line is there's really no way out of this without pain. I mean, it's kind of like being an alcoholic. I mean, we've been drinking too much, and we've been dealing with the hangover by drinking more. And we got to stop drinking, and then and that's a painful process, stopping drinking. But guess what? If you stop drinking and reset to a sound money standard, then we'll go back to having a normal life and a normal economy, and inflation won't be the big problem that it is, and we'll be able to meet our commitments, and there won't be all the political strife and the wealth inequality. I mean, all the problems that we're solving from right now, in my opinion, emanate from the issue of having an unsound currency, and that started in 71.
He transitioned to sound money would mark the end of the era of fiat currency dominance, which began in 1971 when the U.S. abandoned the gold standard. Lepard argues that this shift is essential for addressing the systemic issues plaguing the global economy, from unsustainable debt levels to wealth inequality and political instability. By anchoring the monetary system to assets that cannot be printed or manipulated, the world can achieve a more equitable and resilient economic order. As he concludes, Lepard reminds us that the journey to sound money is not just about financial preservation, it is about securing a better future for the next generation. The path may be arduous, but the rewards, a stable economy, reduced inflation, and a more just society, are well worth the effort.
Please like and subscribe my channel.